If you see the title of Ind AS 8, Accounting Policies, Changes in Accounting Estimates and Errors, it will immediately remind you of our Accounting Standard 5. The title of our Accounting Standard 5 is Net Profit or Loss for the Period, Prior Period Items and Changes in Accounting Policies. The issues which are covered in Ind AS 8 and Accounting Standard 5 are similar. However, the accounting treatment is very different. Let me make it very clear. What we are doing as per Accounting Standard 5 and what we are expected to do as per Ind AS 8, there is a tremendous difference between the two. First and foremost, before I even discuss anything about Ind AS 8, let me make one thing very clear. Accounting Standard 5 also deals with extraordinary items. In India, when we are applying the regular accounting standards, we do classify certain items as extraordinary items. However, under the Ind AS system, no item will be classified as extraordinary. Accounting Standard 5 gives a definition of extraordinary item. Accounting Standard 5 identifies certain items to be classified as extraordinary and accordingly to be reported in the financial statements. No requirement of extraordinary item is there under Ind AS 8. Let us see the issues which are there in Ind AS 8 and how exactly we are supposed to deal with them under the Ind AS system. The title itself is making it very clear. There are 3 segments in the Ind AS 8. The first segment will deal with accounting policies. The second segment will deal with accounting estimates. And the third segment, in the title they are simply saying errors, but this is nothing but prior period errors, which in Accounting Standard 5 we are calling as prior period items, isn't it? Let us start with the first segment, and that is with respect to the accounting policies. We know that under Accounting Standard 1 and even as per Ind AS 1 also, which is dealing with the presentation of financial statements, the very first disclosure that you have to provide in notes to financial statements with respect to accounting policies. You are supposed to give a full-fledged disclosure of all the accounting policies that you have followed and adopted for the purpose of preparation of your financial statements. The question that arises is that what exactly are accounting policies? See, there are certain principles, certain rules that you will have to follow when you are preparing the financial statements. We cannot prepare financial statements as per the whims and fancies of the management of the enterprise. Also, it is absolutely necessary that there is uniformity in accounting practices so that the financial statements of one company in a particular industry can become comparable with financial statements of another company, of course, in the same industry. For this, it is necessary that there are certain principles, certain bases, certain conventions, certain rules that you are following, that you are adopting when you are preparing your financial statements. These rules and conventions and principles that you are following are nothing but accounting policies. Many a times you will get a choice of accounting policies. At that time, Ind AS 8 is guiding us that how exactly the accounting policy should be selected. If you see the definition, they say accounting policies are specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting the financial statements. And then they have given us a 2-step approach. How should the accounting policies be selected? We have a 2-step approach, and it's pretty simple. See, there are certain items and transactions for which you have a specific Ind AS. If you have a specific Ind AS, you are supposed to follow the accounting practices which are given in that Ind AS. For example, you are entering into a lease transaction. We are having an Ind AS relating to lease. You are acquiring an item of PPE. You are having an Ind AS relating to PPE. You have an intangible asset. We have an Ind AS relating to intangible assets. When you are entering into certain transactions for which there are already available applicable Ind AS, the accounting practices which are given in that Ind AS need to be followed. However, at times you may enter into transactions for which there is no Ind AS available right now. In case if that is so, then how to decide the accounting policy? That will be the step 2. First, we check with the step 1. They are saying step 1 requires that when an Ind AS specifically applies to a transaction, other event or condition, the accounting policy or policies applied to that item shall be determined by applying the Ind AS. If you have an applicable Ind AS, then naturally that has to be the first choice. But what if I enter into some kind of a transaction for which there is no Ind AS available? What to do then? Okay, so that is your step 2. Step 2 provides that in absence of an Ind AS that specifically applies to a transaction, other event or condition, management shall use its judgment in developing and applying an accounting policy. We are leaving it to the discretion of the management. The management will apply its own judgment. Based on its own judgment, they will develop an accounting policy, and then that accounting policy needs to be followed consistently, right? Now, when the management is applying its judgment, there are quite a few things that can be done. And there is a note also which I have given over here. You can even look at international accounting standards. You know, it is quite possible that we may not have an Ind AS right now, but on those matters, you may have an international accounting standard. Hence, when the management is trying to develop an accounting policy for relating to that item, it can definitely consider the international accounting practice. And on the basis of that, they can then design their own accounting policy. Whatever judgment that you are applying, we must ensure that at the end of the day, the financial statement should show a true and fair view. They say the judgment, right? I'm reading from here. This judgment should result in information that is relevant to the economic decision making of the users and reliable, right? The judgment applied by the management in selection of an accounting policy should be such that it does not adversely affect the decision-making capacity of the end users of the financial statements. Basically, the end users are the shareholders. When I receive a copy of the annual report of the company in which I have invested my money, by reading the financial statements, by interpreting the financial statements, by analyzing the financial statements, I should be able to take meaningful economic decision. And the information which is available in the financial statement should be reliable. Okay, so that the financial statements, right, represent faithfully the financial position, financial performance, and cash flows of the entity, reflect the economic substance of the transaction, other events and conditions, and not merely the legal form, something popularly known as importance given to substance over form. They should be neutral, right? Financial statements should be neutral. Financial statements should not be biased. They may be biased from the viewpoint of the management. They may be biased from the viewpoint of the shareholders. No, we require a neutral approach. Financial statements are prudent. Prudent is referring to the concept of prudence over here, or the age-old concept of conservatism. We know conservatism, right? Future probable gains can be ignored, but future probable losses should be provided for. In other words, there should not be any underestimation of liabilities. There should not be any underestimation of losses which the entity may incur. And they should be complete in all material respects. I believe the selection is pretty simple. For those items for which an Ind AS is already available, follow the accounting practices given in that Ind AS. For any item Ind AS is not available, then in that particular event, you should apply your own judgment. But when you are applying your judgment, you have to ensure that the information that is available in the financial statements are reliable. You can definitely develop an accounting policy keeping in mind an international accounting standard or maybe global accounting practices with respect to that particular matter, right? That's the note that they have given to us. They say, for judgment, management may also first consider the most recent pronouncements of international accounting standard boards, and in absence thereof, those of other standard setting bodies, right? You do not have an international accounting standard also relating to that matter. But do you have some accounting practice, let us say under the US GAAP? If so, that can also be used by the management for forming its own judgment. that use a similar conceptual framework to develop accounting standards, accounting literature, and accepted industry practices. Ultimately, at the end of the day, it will fall under the industry practice. It's quite possible that there is an item for which there is no developed accounting standard, but there is a well-developed industry practice. Let's say in India itself, your competitors, your peers in the industry are following that particular practice. You can definitely follow that particular practice. Once an accounting policy has been formed, you should follow the accounting policy consistently. Every year you should not keep on changing your accounting policy. Consistency is the key over here, so that the financial statements over a period of time remain comparable. You do something right now as per a particular accounting policy, then you change it the next year. After 1 or 2 years, you again change your accounting policy. If you keep on frequently changing your accounting policies, the financial information which is given in your financial statements will no longer remain comparable. I will not be able to compare the P&L of the current year with the P&L maybe 2 years back or 3 years back, because in those 2 to 3 years, there are a lot of accounting policies that you have already changed. In other words, Ind AS 8 wants you to follow the accounting policies consistently. This does not mean that an accounting policy cannot be changed. An accounting policy can be changed. Let us see the requirements of Ind AS 8, that how an accounting policy can be changed, right? As I had already said earlier, an entity shall select and apply its accounting policies consistently for similar transaction, other events, and conditions. The main concept is that follow accounting policies consistently. But when can I change an accounting policy? Okay, an entity shall change an accounting policy only if the change is required by an Ind AS. I'll give you the example of leases, right? It's one of the best examples that we can give right now. Leases was covered by Ind AS 17, and then a new Ind AS was introduced, which is Ind AS 116, right? Now Ind AS 17 has been superseded by Ind AS 116. You must be following a particular accounting policy as per Ind AS 17 for your lease transaction. But now a new Ind AS 116 is introduced. You'll have to now transit from Ind AS 17 to Ind AS 116. The change in the accounting policy is required by the Ind AS itself. Or you might be following a particular Ind AS, and that Ind AS gets revised and a new accounting policy is introduced. You will have to change the accounting policy. If a change is required by an Ind AS, you have to follow the Ind AS. You can even call this as compulsory change in your accounting policy. Can an accounting policy be changed voluntarily? Right, let's say the change is not required by the Ind AS, but can I voluntarily change my accounting policy? It is possible to voluntarily change your accounting policy if what is given over here is getting fulfilled. Why will I change an accounting policy voluntarily? Maybe I am following a particular accounting policy, but I realize that all of my competitors are following a different accounting policy for that particular matter. Okay, for example, I might be valuing inventory on FIFO basis, while all my competitors are valuing inventory on weighted average basis. I feel that I am the odd one out. My financial statements are not actually comparable with that of my competitors because of the difference in the accounting policy. Okay, selection of accounting policy is not incorrect. I was given a choice of valuing inventory on weighted average or FIFO. I felt FIFO is better for my business, and that's the reason I selected FIFO. But over a period of time, I realized that my competitors are not following FIFO. They are following the weighted average cost method. And hence, I want to shift from FIFO method to the weighted average method. This is not required by an Ind AS. Okay, Ind AS has given me a choice, and I had elected to go for the FIFO approach. But I want to change this voluntarily because all of the peers in the industry are following a different accounting policy compared to mine. Can I do it so? Of course you can do it. When can you voluntarily change an accounting policy? Here it is. When can you voluntarily change it? You can change an accounting policy voluntarily if the change results in the financial statements providing reliable and more relevant information. As I said, my competitors are following weighted average. I also follow weighted average. Now my inventory is more reliable compared to what I was showing earlier. About the effects of transactions, other events or conditions on the entity's financial position, financial performance, or the cash flows. That's what accounting policies are all about. Accounting policies ultimately will result into the determination of your carrying amount of the assets and liabilities, your financial performance, which is nothing but the profit or loss, and the eventual cash flows. So please keep this thing in mind. As far as possible, follow an accounting policy consistently. Do not change your accounting policies frequently. Accounting policy can be changed if it is required by another Ind AS, that is a compulsory change in the accounting policy. Accounting policy can also be changed voluntarily if the change in the accounting policy will provide better information in the financial statements. If you are getting more reliable and more relevant information about your financial performance, about your financial position, about your cash flows, you should definitely change the accounting policy. Yes, be clear about two items which are basically not a change in accounting policy. Please understand this thing. It's quite possible that you are doing a transaction in a particular manner and now you are entering into an altogether new transaction, and for that you are adopting a new policy. We cannot say this is a change in accounting policy. Okay, they say the application of an accounting policy or transactions, other events or conditions that differ in substance from those previously occurring, right? For example, you have been selling on cash basis and selling on credit basis. You are having proper accounting policies relating to recognition of revenue for these sales. But from the current year, you have basically started also selling on approval basis. Sale on approval basis, many a times it is also popularly known as sales on return basis. What you have done is you have now started supplying your goods. You are giving 15 days time to the prospective buyer. Within 15 days, they have to acknowledge whether they are buying or not buying the goods. If they are not buying the goods, they have to return back the goods during this window period of 15 days. This is something that you have never done till now. You have a proper accounting policy for recognition of revenue for cash sales, recognition of revenue for credit sales, but now you are developing a new accounting policy for sale on approval basis. This is a transaction which differs in substance from those previously occurring. You are developing a new accounting policy for the sale on approval basis. You cannot say this is change in accounting policy. This is a new transaction that you are entering into, different from what you were doing till now. For that, if you are developing an accounting policy, you cannot say this is change in accounting policy, right? Or the other one, the application of a new accounting policy for transaction, other events or conditions that did not occur previously or were immaterial, right? For the first time, you are acquiring an item of PPE on lease basis. This is an event which had never occurred previously. For the first time, you are entering into a lease transaction. You will now have to develop an accounting policy for this brand new transaction. You will have to consider this as adoption of a new accounting policy. This is not a change in accounting policy. Okay. If I am changing an accounting policy, then how shall I give the effect of the change in accounting policies? Whenever you change an accounting policy, the effect of change in accounting policy has to be given retrospectively. By retrospective, we mean as if the new accounting policy was followed right from the very beginning. As if right from the very beginning, the new accounting policy which you are adopting now was followed by you. That is what we mean by a retrospective change. Getting it? They are saying effect should be given retrospectively as if the new accounting policy had always been applied. As we were taking that earlier example, isn't it? you are changing your accounting policy for inventory valuation. All these years you have been following FIFO method, but now you have finally decided that you will follow the weighted average method. Right from the very beginning, if you had followed the weighted average method, then what would have been the value of your inventory? What I am trying to say is that if you are changing an accounting policy today, you are not supposed to give the effect of the new accounting policy from today and onwards. If you say today and onwards, that means you are giving prospective effect. No. Ind AS 8 requires that whenever you are changing an accounting policy, its effect should be given retrospectively. Retrospectively, as if right from the very beginning, I had been following the inventory valuation, the new inventory valuation method. Let us assume for a moment that this company was formed 5 years ago. You have been doing inventory valuation since last 5 years as per FIFO basis. You are now saying I will follow the weighted average method. Okay. Right from the very beginning, that is 5 years ago, right from the very beginning, if you are following the weighted average method, then what would have been the value of your inventory? If this is what you are doing, then we can say that you are giving the effect retrospectively. In other words, a change in accounting policy will affect not just the current year, it will also affect the previous years, isn't it? So how exactly should I provide the effect of change in accounting policy? Now this is a matter on which I will require your utmost attention, because what we are going to discuss now is something that we have not done in India. We have been following Accounting Standard 5. I told you earlier also, Accounting Standard 5 also deals with change in accounting policy. When I say that change in accounting policies effect will be given retrospectively, you will not be surprised. If you are aware about Accounting Standard 5, the same stand is taken also by Accounting Standard 5. AS5 also says that whenever you are changing an accounting policy, its effect should be given retrospectively. Ind AS 8 also says that whenever you change an accounting policy, its effect should be given retrospectively. But let me tell you, the similarity ends over there. Okay, the similarity ends over there between AS5 and Ind AS 8. The way the effect of the retrospective change in the accounting policy is to be given in the financial statements, it is materially different in Ind AS 8 and Accounting Standard 5. So that's the reason I am saying I require your utmost attention now, because what we are going to discuss is something very different from what we have been doing all these years under Accounting Standard 5. Okay, let us understand this. You are saying I have changed an accounting policy with respect to the inventory valuation. Okay, let us say we are finalizing our financial statements for the year 2021. Let us say our balance sheet date. Okay, our balance sheet date is 31st March 2021. I'm finalizing my financial statements for the year 2021. On 31st March 2021, I'm making a change in accounting policy. Okay, I'm making a change in accounting policy. We know that if you are changing the accounting policy, its effect should be given retrospectively. Hence, I'm giving its effect retrospectively, right? I will do the calculation for the change in the accounting policy as if the accounting policy was followed right from the very beginning. And I will work out what is the change in the accounting policy. Okay. Now, since you are doing retrospective calculations, certain change in accounting policy will be for current year, certain change in the accounting policy will be for the previous year, and certain change in the accounting policy will be for a period before the previous year. I hope you are agreeing with me. For example, this company was formed 5 years back and now it is changing its inventory valuation method. In other words, I will give effect retrospectively from 5 years back and I will do the entire calculation. Hence, the change in the inventory valuation, certain change will be for the current year, certain change will be for the previous year, and certain change will be for period before the previous year. Let's put it in this way. We are bringing about change in the accounting policy. We work it out. We say effect of change in accounting policy right? 2020, 21, 2019 and 20, and then we say before 2019, 20. We are determining the change in the accounting policy. Let us say for simplicity, it is 10,000 over here. Okay. It is 12,000 over here. And before 2019-20, let us assume that it is turning out to be 8,000. Okay. If I take a total over here, the total is turning out to be 30,000. The total change in these 5 years for the change in the accounting policy is 30,000. But we are breaking it down into how much for the current year, how much for the previous year, and how much for the period before the previous years. This is how I am giving the effect of the change in the accounting policy. I'm basically taking a calculation which has been carried out retrospectively. Now, what do we do under Accounting Standard 5? Let me first discuss AS5 because that you already know. Accounting Standard 5 says that whatever is the change in the accounting policy, its effect should be given entirely in the period in which the accounting policy is changed. Okay, when are you changing your accounting policy? You are changing your accounting policy in 2020-21. Please understand the words of Accounting Standard 5. AS5 says that, see, whatever is the cumulative effect of the change in the accounting policy, that entire cumulative effect should be recognized in the period in which the accounting policy is changed. Here I am getting 30,000, right? That is the cumulative change in the accounting policy. If I follow Accounting Standard 5, as per AS5, entire 30,000 should be captured in 2020-21. This 30,000 can be a surplus, this 30,000 can be a deficit. I'm not getting into it, whatever it is. But you will have to either credit the P&L or debit the P&L of 2020-21. Although you are doing a retrospective calculation, but the cumulative effect will not be given retrospectively. The cumulative effect will be given in the period when you change the accounting policy. If you follow Accounting Standard 5 over here, entire 30,000, as you can see, will be debited or credited to the P&L of 2020-21. Whatever is the effect of the change in the accounting policy on the P&L, whatever is the effect of the change in the accounting policy in the carrying amount of the assets and the liabilities, everything will be recognized in the year in which, in the period in which you change the accounting policy. That's the stand taken by Accounting Standard 5. What does Ind AS 8 suggest? Yes, Ind AS 8. Understand. See, you already have a breakup. You already have a breakup of the change in the accounting policy. Just see. What will Ind AS do? Ind AS 8 do, sorry. What will Ind AS 8 do? 10,000 is for the year 2020-21. Its effect should be given in the year 2020-21. Okay, 10,000, let's assume for a moment that 10,000 is to be debited. Okay, then 10,000 will be debited to the profit and loss account of 2020-21. After all, you have done a retrospective calculation. Out of the cumulative effect, 10,000 is relating to the current period. If 10,000 is relating to the current period, naturally it has to be adjusted in the current period. Okay. What about 2019-20? Okay, tell me one thing. When you will prepare the financial statements for, 2020-21, will you not give comparative figures? Will you not give comparative figures? See, when you receive a copy of the annual report of a company, you are not having figures only of the current year. Previous year figures are also given for comparison. You get my point? So when I will disclose the figures of the current year, side by side, I will also provide figures for the previous year. This previous year figures, they are popularly known as comparative figures. Whatever is the effect of the year 2019-20, it will be given in the comparatives. You get my point? So when you follow Ind AS 8 over here, the effect will be given in 2019-20 comparatives, right? You'll be preparing the financial statements And when you will be preparing the financial statements, you will provide figures for the current year, and you will also provide figures for the previous year by way of comparatives. Change the comparatives. Okay, change the comparatives. Whatever effect is for the previous year, give it in the comparatives. But what about the effect of the years before the year for which comparatives are given? If I am doing business since last 5 years, I am not going to prepare a P&L and a balance sheet, give the current year figures, and then also give 5 years figures for comparison, right? Comparatives will be given only for the previous year. But then because you have done a cumulative effect, this will also have a bearing on the years before the year for which comparative will be given. What to do over here? Okay, think about it. What will be needed to be done over here? Current year effect in the current year, previous year effect in the comparatives. But what about the effect for the figures or for the change in the accounting policy which relates to period before the preceding year? What to do over here? Okay, just think for a moment. Just think for a moment that once that effect will be given, right? Current year, think about the year before the current year. Before the current year, if you are giving effect over there, what will happen? The profit of that particular year will change. The assets and liabilities of that particular year will change. In other words, what will happen is your opening balances of the assets, liability, and items of equity will change, isn't it? That is exactly what you will be doing for the period before 2019-20. Before 2019-20, try to understand this. Before 2019-20, we understand this as period before preceding year, right? 2020-21 is the current year, preceding year is 2019-20, and this is a period even before that. Those opening balances should be changed. Opening balance of the affected asset, the opening balance of the affected liability, the opening balance of the items of equity, that should be changed. That is how the effect will be given. So if I'm applying Ind AS 8 over here, right? As I'm applying Ind AS 8 over here, I will say opening balances for the year 2019-20 shall be changed, right? Shall be changed. See, this is your previous year, right? This is your previous year. Ask yourself, when will this previous year start? The previous year will start on 1st April 2019. Hence, on 1st April 2019, whatever is this 8,000, okay, whatever is this 8,000, this 8,000's effect should be given in the opening balances, because this is for the year before it, right? This 8,000 is for the period before 2019-20. Hence, if the years before 2019-20 are debited by 8,000 rupees, the immediate consequence of that will be that the opening balances of the beginning of the previous year will change. So you have to simply give the effect over there. Not only that, over here, as per Ind AS 1, there will be one more requirement. Ind AS 1, presentation of financial statements, it suggests that you have to prepare a third balance sheet in certain circumstances. Please hear me out. Ind AS 1, presentation of financial statement suggests that, see, you have to prepare a third balance sheet under certain conditions, under certain circumstances. Question that arises is that what is this third balance sheet? You know, you can have a third balance sheet only when you already have first and second balance sheet. Where is the first and the second balance sheet? Okay, where will it be? It's very clear. Your year is ending on 31st March 2021. You will prepare your balance sheet on 31st March 2021. Balance sheet will be prepared on a particular date, isn't it? This is nothing but your first balance sheet. Then for comparison, you will give figures on 31st March 2020, right? This is nothing but your second balance sheet. Okay. Whenever you are receiving a copy of the annual report, actually there is not one balance sheet over there. There are two balance sheets over there. There is not actually one P&L. There are two P&Ls. I hope you are getting it, because comparative figures are also given. But now what has happened is the period before the second balance sheet is also getting affected. And that is the reason you have to now prepare a third balance sheet. A third balance sheet is required to prepare as per Ind AS 1 whenever you are giving effect of any item retrospectively. I will draw your attention to the requirement of Ind AS 1. This is the presentation of the third balance sheet. Okay. An entity shall present a third balance sheet as at the beginning of the preceding period in addition to the minimum comparatives if it applies an accounting policy retrospectively. You are giving an effect of an accounting policy retrospectively, makes a retrospective restatement of items in its financial statements, or reclassifies items in its financial statements. The other two are not applicable to us right now. We are discussing applying an accounting policy retrospectively. Whenever you are applying an accounting policy retrospectively, there is a possibility of preparing a third balance sheet, provided this second condition is also getting fulfilled. The retrospective application, retrospective restatement, or the reclassification has a material effect on the information in the balance sheet at the beginning of the preceding period. You are providing comparative information, but the period before the comparative is also getting materially affected. If it is getting materially affected, you must prepare a third balance sheet. And that is what will happen over here. As you change the accounting policy over here retrospectively, right? As you change your accounting policy retrospectively, you will have to give the effect for the current year in current year, previous year in the comparatives, and any period before the previous year by adjusting the opening balances. And when you are changing the opening balances of the previous year, as per Ind AS 1, you will also have to present and prepare a third balance sheet. This is what we are doing. Adjust the comparative amounts disclosed for prior period presented, and another thing, adjust the opening balance of each affected component of equity for the earliest prior period presented. Okay. So whenever you are giving the effect of the accounting policy retrospectively, this is what will be done, right? This example that we have taken is basically helping us understand not just the accounting treatment under Ind AS 8, it also helps us understand what will happen under accounting standard 5. You know, you can compare and contrast. We go for a very simple treatment in AS 5. Entire 30,000 cumulative effect recognized in the period in which the accounting policy is changed, matter ends, right? The matter ends there. Ind AS 8 takes it to its logical conclusion. I personally believe that the treatment of Ind AS 8 is far more superior compared to accounting standard 5. Why should I do a retrospective calculation which involves previous years also, but ultimately give effect entirely in the current year? Isn't it? Whatever is relating to current year, give effect in the current year. Whatever is the effect for the previous year, adjust the comparatives. And whatever is the effect for the period before the previous years, please change the opening balances of the affected assets, liabilities, and items of equity. This will also result into a presentation of a third balance sheet as per Ind AS 1. What more? Okay. The example that we had taken was the example where we were planning to change our inventory valuation method. We were suggesting that all these years we have been following the FIFO method, but our competitors are following weighted average, and hence finally we decide to follow the weighted average. The moment you are deciding to change your accounting policy with respect to inventory valuation, we realize that Ind AS 8 requires a retrospective calculation. And hence we have done a retrospective computation that if this new accounting policy was followed right from the very beginning, what would have been the position? But you know, the important thing in our illustration was that the company was formed 5 years ago. Let us say the company was formed 50 years ago, and now it is deciding to change its accounting policy. What do you say? The company was formed 50 years ago. Now you are saying I will change the accounting policy. Okay, if you want to change the accounting policy, you have to give its effect retrospectively. As if right from the very beginning, you were following the new accounting policy. As if right from 50 years back, you were following this new accounting policy. Do you really feel that there shall be practical difficulties this time in developing the necessary data relating to the change in the accounting policy? What do you say? Or do you feel that 5 years back or 50 years back, what difference does it really make? Okay, the company just recently celebrated 150 years of its existence. And on that particular day, they decided, okay, let's change our accounting policy. Since 150 years, we are following this accounting policy. Don't you feel you are tired? Since last 150 years, you are following a particular accounting policy. You feel, okay, let us change this accounting policy. You tell your accountant that we are changing the accounting policy. Your accountant will just keep on looking at you. The accountant will explain to you that, see, if you change an accounting policy, its effect has to be given retrospectively. I will have to open all the P&Ls, all the balance sheets of the last 150 years so that I can accurately project what will be the cumulative effect of the change in the accounting policy. Will you really be interested in doing this? It is quite possible that this particular accountant will do only this work throughout the year, and even at the end of the year he may not have the necessary data available, because going through calculations of the last 150 years of your existence, you are really asking too much. You know, this is a point which has been completely missed out by Accounting Standard 5. AS5 simply says that, see, you should change your accounting policy retrospectively. Ind AS 8 also says you should change your accounting policy retrospectively. But where Ind AS 8 differs is, Ind AS 8 does recognize the fact that it is quite possible that when you are changing an accounting policy, retrospective calculation may be impracticable. See, understand, 150 years ago, I can do the calculation. If you are saying that, come on, can't you do it? Of course I can do it, but it is impracticable. It will put unnecessary hardship on me. Think about it. Inventory valuation. Why should I really dig up the records of the last 150 years? Because most of the inventory that I must have produced during those years would have already been sold by me. You get my point? When you change the inventory valuation, what will really affect is the recent transactions. And that's the stand taken by Ind AS 8. Ind AS 8 suggests that, see, if giving effect of a change in accounting policy retrospectively is not possible, then give effect from the period it is practicable. That same example, the company has just recently celebrated 150 years of its existence. Let us say it wants to change its accounting policy. It can do it. It can do it. I'm not saying it cannot do it. We had already seen it earlier that how you can bring about a voluntary change in the accounting policy. You can definitely do it. But we are of the view that calculations for 150 years back is impracticable. Agreed, it is impracticable. From what period can you make it practicable? You feel that the recent inventory valuation is perhaps more important. You realize that instead of 150 years, it is practicable for me to do this calculation since last 5 years. Fine, you can give the effect of a change in accounting policy from the period from which it is practicable. There is no rule over here that no, we have written retrospectively, that means you have to do calculation retrospectively. No, the real hardships are, or rather I'll say the hardships of the real world are definitely captured in Ind AS 8. Yeah, there's one more point over here, the note actually. They are saying that early application of Ind AS is not a voluntary change in accounting policy. You know, many a times Ind ASs are prepared and then Ind AS is also notified, but they are saying that the Ind AS will come into effect from 1st April 2024. But I want to start applying it from 1st April 2022. And hence I'm going for a voluntary adoption of the Ind AS, early adoption of the Ind AS. You cannot say it is a voluntary change in accounting policy. We know an accounting policy can be changed if it is required by an Ind AS. Early adoption will fall into that category. Okay. Yes, the point that we were discussing. Retrospective effect of change in accounting policy is impracticable. Then give the effect from the period it is practicable. They say when it is impracticable for an entity to apply a new accounting policy retrospectively because it cannot determine the cumulative effect of applying the policy to all the prior periods. As I said, my company was formed 25 years ago. I do not have all the information relating to all the prior periods. Entity will apply the new policy prospectively from the start of the earliest period practicable. I have been doing my business since last 25 years. I am changing my accounting policy. Basically, for Ind AS 8, I have to do a retrospective calculation for all the 25 years. But this is becoming impracticable for me. But I can do calculations for the last 5 years. Right, you are basically applying it prospectively, but from the start of the earliest period practicable. I feel that last 5 years calculations can definitely be done. Then from last 5 years, I will do my calculation for the change in the accounting policy. Entity therefore disregards the portion of the cumulative adjustment to assets, liabilities, and equity arising before that date. You may say 25 years, only you are doing calculation only for 5 years. What about the 20 years preceding that? Entity will disregard the same, right? Whenever the change in the accounting policy retrospective calculation is impracticable, this is the way out under Ind AS 8. Do your calculations, but from the period from which it is practicable. Period before that shall be ignored. But once the calculations have been done, the effect will be given in the similar manner. Effect for the current year in current year, effect for previous year, adjust the comparatives, and effect for the period before the preceding period, change the opening balances of the affected assets, liabilities, and of course the items of equity. And as per Ind AS 1, you will also have to present a third balance sheet. And of course, in notes to accounts, you should give a full disclosure of the accounting policy that you have changed and what has been its ultimate material effect. The second segment of Ind AS 8 is accounting estimates. Whenever we are preparing and finalizing our financial statements, there are a lot many items for which estimates will be required. The actual outcome will be known in future, but I cannot wait for accounting to be done in future. See, what will be the real amount that will be known in future, but accounting is not to be done in future. Accounting is to be done right now. And hence, without making estimates, it will simply not be possible to carry out the accounting. One of the classical examples of accounting estimate is depreciation. Think of it. When you are calculating depreciation, you have to estimate the useful economic life of the asset. When you are calculating depreciation, you have to estimate at what salvage value you will be able to sell at the end of the useful economic life of the asset. These are estimates, and only on the basis of this estimate, you can calculate the depreciation. The actual salvage value will be known in future. The actual useful life will be known in future, but I cannot wait till the future to reveal the right figures because depreciation needs to be provided as of now. That is what we mean by estimates over here. I know I am selling on credit basis. I know that certain amount of my debtors will go bad, but that I will come to know only in future. Should I wait till the actual event occurs in future, or should I make an estimate of provision for bad and doubtful debts right now? Obviously, I have to make an estimate right now. I am selling on warranty basis. I know that certain goods manufactured by me may develop manufacturing defects. I know that when those products will be returned back to me, I will have to repair those products at my cost. How many products will be returned back? What will be the repair expense? Everything will be known in future. But the provision for the warranty cost has to be recognized right now. And that is the reason an estimate has to be made. I have a pending lawsuit. The judgment of the court will be out in future, and then ultimately I will come to know what is the amount of damages that I will have to pay. I am not supposed to wait till future, till the judgment is out. Today itself I will have to make some estimate of the amount of damages payable, and accordingly I will have to recognize a provision for the same. This is again nothing but an estimate. I will have to estimate the fair values of assets and liabilities. I will have to estimate the net realizable value of my inventory. There are so many accounting estimates that are required to be carried out. Ind AS 8 says that whatever information is available currently, you should use that information and work out what is the amount of the estimate. Remember, better data will be available only in future. Remember, better information will be available in future. As you will become more experienced in future, your estimate will gradually become more and more accurate. That is the reason, as better information is available in future, you can definitely change the amount of the estimate. But unlike an accounting policy, a fact of change in accounting estimate shall be given prospectively. Accounting policies are changed retrospectively, but not accounting estimates. Today I am of the view that 5% of my debtors will go bad, and hence I am recognizing 5% of the debtors as provision for bad and doubtful debts. As I said, as years will pass by, I will have more and more experience. I realize over a period of time that only 2% of my debtors are going bad. In future, I will reduce the provision for bad and doubtful debts. Or to the contrary, I come to the conclusion that 7.5% of my debtors are going bad. I will have to increase the provision for bad and doubtful debts. But as I said, a fact will be given prospectively. You will not disturb the provision for bad and doubtful debts recognized in the previous years. You know why? Today I am of the view that 5% of my debtors will go bad. That is the information available right now. Based on that information, I have recognized an accounting estimate. As in future better information is available, I will update the amount of the estimate. I am not committing any mistake right now. Based on the information that I have right now, I feel 5% of the debtors going bad is reasonable. So based on that, I am recognizing an accounting estimate. It's not that I'm committing any mistake right now, but as I gain more experience, yes, I will change the estimate in future. Changing the estimate in future does not mean what you had done in the past was incorrect. Whatever I did in the past was based on the information, facts and circumstances that were available at that point of time. As these facts and circumstances change, as I gain more experience, as better information is available, as more reliable information is available, I will change the amount of the estimate. I haven't committed any mistake in the past, and that's the reason a fact of change in accounting estimate shall be given prospectively. Prospectively means it will affect that period or that period and future periods. Getting it? So that is how the effect will be given for the change. Relatively, it's a simpler topic compared to the accounting policies. Yes, let's go through our notes over here. They say as a result of uncertainties inherent in business activities, many items in financial statements cannot be measured with precision, but can only be estimated. Estimation involves judgment based on latest available reliable information. As I said, whatever information is available right now, not the one available in future, that we will come to know only in future. At present, when you are carrying out the estimate, reliable information that is available, I will base my judgment on the basis of that. Certain examples are given of the estimates, which we have already discussed in a way. Provision for bad and doubtful debts, inventory obsolescence, fair value of financial assets or financial liabilities, useful lives of expected pattern of consumption of future economic benefits of depreciable assets, warranty obligations, and these are only examples, right? It's not an exhaustive list. There are a lot many other estimates that we are regularly making when we are preparing our financial statements. And finally, how am I going to bring about a change in accounting estimate? An estimate will need revision if changes occur in the circumstances on which the estimate was based or as a result of new information or more experience. 5% of my data will go bad. That was my estimation. 2 years down the line, I have more experience. 7.5% of my data are going bad. Please increase the provision for bad and doubtful debts. Right? My lawyers were advising me that for the pending lawsuit, you will have to pay 50,000 rupees of damages. I recognized a provision for rupees 50,000. But when the judgment was out, the court ordered me to pay 60,000. New circumstances are there, right? New circumstances. Because new circumstances are there, I'll have to update the amount of the provision. Getting it? I had estimated that the useful economic life of my depreciable asset will be 10 years. And hence, on the basis of that, I am providing depreciation for 10 years. Accordingly, I have calculated the cost, deducted the salvage value, and based on that, I have worked out that what is the amount of depreciation. 3 years down the line, originally 10 years, that means 7 years should be left. But now looking at the condition of the asset, I feel I can use it only for 5 years. If that is so, then accordingly, I'll have to change the amount of the depreciation. This is nothing but an accounting estimate, or rather I'll say a change in accounting estimate, and accordingly the revised depreciation will be determined. So when circumstances change, so shall the change in the accounting estimate, right? My lawyers were advising me that, see, do not worry at all, you will win this particular case. And that is the reason I did not recognize any provision. But as on the balance sheet date, there are some new developments in the case, and based on that, my lawyers are now advising me that you may lose the case now and be prepared to pay damages of 30,000, right? New information is available right now, and based on that new information, I may have to make a fresh estimate. In other words, a change in accounting estimate can be made if there is a change in the circumstances or better information is available or as you gain more experience, right? Remember, change in accounting estimate is not a prior period error. We have still not discussed prior period errors, but please understand this. Do not consider what you have done in the past as incorrect. If you say what I did in the past is incorrect, that means you are trying to correct it now, then it will be considered to be a prior period error. Change in accounting estimate is not treated as a prior period error. Remember, revision of an estimate does not relate to prior period, is not a correction of an error. Effect is to be given prospectively. I am not supposed to change the figures of the past years. How can you say it is an error committed in the past? Whatever information was available in the past, I used it to make my estimate. As that information changes, I have every right to change my estimate. But that does not mean you tell me that you committed a mistake in the past. I haven't committed a mistake in the past. Okay. And that is the reason it is not a prior period error. Remember, effect of change in accounting estimate is recognized prospectively by including it in profit or loss. Whenever you are making a change prospectively, either it will affect only the current year or it will affect current year and future years. For example, you are recognizing a provision for the damages that you will have to pay. There is a pending lawsuit and that lawsuit judgment will be out in the current year anytime. We really do not know what will be the final amount of the damages, and hence I have estimated that. This estimation for the damages payable will affect only the current year. But when you are changing the useful economic life of the asset, when you are changing the salvage value of the asset, this will affect depreciation for current year. It will also affect depreciation for the future years. Remember, a change in accounting estimate will never affect previous years. Either it will affect current period or it will affect current period and future periods. They say it should be included in the period of change if the change affects only that period, or period of change and future periods if the change affects both, right? Similarly, there are also the assets and liabilities and items of equity that may also get affected. Everywhere the effect will be given prospectively. To the extent the change in accounting estimate affects the balance sheet, its effect shall be recognized prospectively by adjusting the carrying amounts of the related asset, liability, or equity item in the period of change. Right? Similarly, a change in the measurement basis. This is an important point that we are discussing now. Change in the measurement basis applied is a change in an accounting policy and not a change in the accounting estimate. For example, you are moving from cost model to revaluation model. This is changing the way the items of PP will be measured. You cannot say this is a change in accounting estimate. This is a change in accounting policy. From FIFO method, you are moving to weighted average method. This will be considered to be a change in accounting policy, not a change in accounting estimate, right? However, do remember, under Ind AS 16, moving from straight line method to WDV or vice versa is now no longer considered to be a change in accounting policy. It will be considered to be a change in accounting estimate. That's a very important point that you have to always remember. You know, whenever we are asked to give examples of change in accounting policies, one of the first example that strikes us is that when we change the method of depreciation, all these years we have been understanding change in method of depreciation as a change in accounting policy, and hence we have been giving its effect retrospectively. But Ind AS 16 says that when you change the method of depreciation, it is a change in accounting estimate. It is no longer a change in accounting policy, and hence when you move from SLM to WDV or WDV to SLM, you have to give its effect prospectively, right? And finally, let us say there is a lot of confusion that whether this is change in accounting policy or change in accounting estimate. Then they are saying the change is treated as a change in accounting estimate whenever it is not possible for you to distinguish between the two. It says when it is difficult to distinguish a change in accounting policy from a change in accounting estimate, the change is treated as a change in accounting estimate. In short, the effect shall be given prospectively. Let us deal with the final segment of Ind AS 8, which is dealing with prior period errors. In our accounting standard 5, we understand this as prior period items, right? We use the term prior period items. Ind AS 8 is using the term prior period errors. The concept of prior period error and prior period item, it is actually the same. What we understand in accounting standard 5 is that prior period items are any error, any omission that you have committed in the past, which is detected in the current period, right? In the current period, we realize that there were certain mistakes that we have committed in the past years. There are certain omissions in the financial statements of the past years, and we want to now rectify those errors. We want to rectify those omissions. That is what we refer as a prior period item. Similarly, under Ind AS 8 also, the concept is the same. In the past year, when you were finalizing the financial statements, information was available, but you failed to use that information, or that information was misused, and because of that there are certain errors and omissions in the financial statements of prior periods. That is what we understand as a prior period error under Ind AS 8. However, just like it was the case of accounting policies, the way we are giving the effect of prior period items in accounting standard 5 and the way you will give the effect of a prior period item under Ind AS 8, it is dramatically different. Yes, significantly the accounting of the prior period item and prior period errors is different. What you have studied in accounting standard 5 will only help you in understanding the meaning of prior period error. But how should the effect of a prior period error be given under Ind AS 8 is very different from what we are doing under Accounting Standard 5. I will again explain you on the basis of AS 5 only. That's an easier way of understanding. I already know what is there in Accounting Standard 5. Hence, it becomes that much easy for me to compare and contrast the accounting difference. After all, at the end of the day, as an accountant in India, you should be aware about Ind AS and you should also be aware about the accounting standards. It's not that accounting standards are dead now in India, as if we will now no longer apply the accounting standards. It's not so. You ought to be aware about both the set of pronouncements. That's the reason we will discuss the accounting, or we can say the presentation of the prior period items, by understanding what we do in AS 5 and also by comparing and contrast, as I said, with Ind AS 8. First of all, let us be clear with the meaning. As I said, the meaning is more or less the same. The choice of words in the definition is different, but ultimately the outcome is the same. Prior period errors are omissions from or misstatements in the entity's financial statements for one or more prior periods, arising from a failure to use or misuse of reliable information. Information was already available as on the balance sheet date, but you failed to use that information or you misused the information. Both of them will give rise to a prior period error. Right? There can be different types of prior period errors. I may have committed some mathematical mistake. I may have misinterpreted the facts given to me. I may have made some conceptual errors. I may have not given the necessary disclosures. Many mistakes are possible. They are saying reliable information was available when financial statements for those periods were approved for issue and could reasonably be expected to be obtained and taken into account in the preparation and presentation of those financial statements. Right? Information was available, but I failed to use that information, or information was available, but the information was misused. Misuse of information can also give rise to a fraud, and detection of fraud in the current year about a fraud taking place in the previous years will also be considered to be a prior period error. Such error include the effects of mathematical mistakes. As I said, a stock sheet was prepared and one item of inventory was totaled twice. I can say it's a mathematical mistake, or one item was simply omitted to be added. This is nothing but a mathematical mistake. It was committed in the past year and it was detected now in the current year. In the current year, since this item is relating to the previous year, I will consider that as a mathematical mistake. Mistake in applying accounting policies. Certain items were required to be capitalized to the cost of the PP, but instead they got debited to the profit and loss account. I could not apply the accounting policy properly. Yes, this is also giving rise to a prior period item. Oversight. Okay, there were certain vouchers, right? Let's say there is a large number of purchases which were made during a month. The accountant was feeding the data in the software, voucher out of voucher, and he is turning the voucher. By mistake, the accountant turned two vouchers together. One purchase was omitted to be recorded. I can say that this has happened because of an oversight. Or there can be misinterpretation of facts. Even misinterpretation of facts can give rise to prior period errors. A misinterpretation of fact can be with respect to classification. For example, certain liabilities were required to be classified as current, but you misinterpreted the fact and you classified that as non-current. This can result into a current liability being shown as a non-current liability in the previous year, but that mistake is now finally detected in the current year. This can be a misinterpretation of fact. There is some event which is occurring after the reporting date. It is actually an adjusting event, but I misinterpreted the fact and treated that as a non-adjusting event and gave only a disclosure with respect to the same. In the current year, I realized that this was a misinterpretation of fact and it can give rise to a prior period error. And finally, and really important, we will not come across the word fraud in Accounting Standard 5. In AS5, fraud will be treated as an extraordinary item, isn't it? But as we have already discussed, there is no concept of extraordinary items under Ind AS 8. A fraud will be treated as a prior period error. A fraud was going on in the previous year or years. You failed to detect it at that time. In the current year, you detect that a fraud is going on since long. The non-detection of fraud in the previous years will be treated as a prior period error. Okay, I finally realized that there is a prior period error. How should this prior period error be given effect to? Ind AS 8 says that the effect of prior period error should be given retrospectively, something that we do not do under Accounting Standard 5. Under AS5, just like change in accounting policies, effect of the prior period item is given in the period in which the prior period item is detected. This accounting treatment which is given in Accounting Standard 5 is very difficult to accept. Again, Ind AS 8 is giving a far more logical treatment for prior period errors. What we do in our Accounting Standard 5 is, in current year, we realize that in the previous year, we have committed a mistake. Instead of giving effect in the previous year, we give its effect in the current year. You know what happens because of this? Think in this way. Let us say there was some voucher of 10,000. Let's say there is some expense of 10,000. Let us say wages. Wages of rupees 10,000 of the previous year was somehow omitted to be recorded. Audit also got completed. Financial statements got finalized, approved, everything. We even filed with the regulator and everything. And then in the current year, we realized that 10,000 rupees of wages of the previous year was forgotten to be recorded, omitted to be recorded. This becomes a prior period item. AS5 says that, okay, 10,000 rupees of wages of previous year was not recorded. Agreed, it's a prior period error. This prior period item's effect will be given in the period in which it was detected. In the current year, you detected a mistake of 10,000 of the past. In current year's P&L, I will give the effect of 10,000. 10,000 rupees of wages of the previous year will be debited to the current year. You know what will be the end outcome of this? Think logically. What will be the end outcome of this? This 10,000 rupees of wages, is it the current year expense? No, it is not the current year expense. It is previous year expense. Previous year expense you are debiting in the current year. You know what you have done? Because previous year's expense is debited to the current year P&L, your current year profit is wrong and your previous year profit is also wrong. Do you agree with me? It can even be a loss figure also, loss figure is wrong. Okay, I hope you are able to get it. Last year you did not record 10,000 rupees of expense. That means last year you overstated the profit by 10,000. Now this 10,000 of the last year you are debiting in the current year. That means you are understating the profit of current year by 10,000. In order to rectify the mistake of the previous year, you are ensuring that the profit of the current year is also incorrect. That's what you do in AS5, isn't it? Accounting Standard 5 gives you a treatment, the end outcome of which is that neither the current year profit nor the prior period profits are correct. Everything is wrong. This is what is happening. Ind AS 8 gives a very different treatment. Since now you are already aware about the treatment of accounting policies, the effect of change in accounting policies, you will not find this very difficult. Error was committed in the previous year. Will you give the previous year figures for comparison? Will you give previous year figures for comparison, isn't it? You should adjust that in the comparatives. As simple as that. Let us say our current year is 2020-21. Okay. Previous year is 2019-2020. In the previous year, rupees 10,000, let's say, wages of rupees 10,000 is not recorded, right? We committed a mistake because of an oversight. I have omitted to record rupees 10,000 rupees of wages in the previous year. If you follow Accounting Standard 5, then this 10,000 will be debited to the profit and loss account of the current year. Last year profit is wrong and current year's profit is also wrong. This is what you will do under accounting standard 5. No. Ind AS 8 says that when was the mistake committed? Mistake was committed in the previous year. Will you provide comparative information for previous year? Yes or no? Yes. Previous year's comparative figure will be changed by 10,000. You will write wages. In the previous year, the wages, whatever you had shown in the previous year, increase it by 10,000. I will present my figures for 2020-21. For comparison, I will provide figures for 2019-2020. Right? Here there will be no effect. Mistake is of the previous year. Why should I give its effect in the current year? Prior period items effect will be never given in the current year. After all, it is not a current year item. That's the reason we are saying prior period, right? That's the reason its effect has to be given in prior year. Mistake was committed in the previous year. Give the effect in comparatives. Increase the comparative. When you will prepare your P&L, when you will present your P&L, you will write employee cost. One of the expenses will be employee cost. Just update the employee cost of the previous year by increasing the amount of wages by 10,000. As simple as that. Whenever you have committed a mistake, you realize that the mistake was committed in the year for which comparative information is provided. You should give the effect in the comparative information. Okay. Let us take another situation. Let's take another situation. Current year. Let's say current year is 2020-21. Let's take the same example. Wages of rupees 10,000 of 2016-17 not recorded. Let's put it in this way now. The earlier example was with respect to an expense forgotten to be recorded, omitted to be recorded, but for the previous year. If the mistake is relating to previous year, I can easily correct it in the comparatives. But what if the mistake was committed for a period before the year for which comparative information will be provided? Then what to do? This is that example, right? This time what will happen is I will prepare my P&L and I will provide the information of the current year. Here there will be no effect. After all, the mistake was not committed in the current year. I shall provide information relating to the previous year for comparison. Here also there shall be no effect. After all, this 10,000 mistake is not for 2019-20, it is for 2016-17. What to do then? Come on, you already know how you should give the treatment of changes in accounting policy. Remember, how are you giving the effect of changes in accounting policy? Relating to the current year in current year, relating to the previous year in comparatives, and relating to a period before the preceding year for which comparatives are available. You should change the opening balances. That's what I will be doing over here. Just think for a moment. Just think for a moment. If you open the P&L of 2016-17 and debit that by 10,000 rupees of expense, what will happen? What will happen? The profit for the year ended 31st March. The profit for the year ended 31st March 2017 will go down. This closing balance will then become opening balance for the next year. What will happen? The balance on 31st March 2018 will also go down, isn't it? Then what will happen? The balance of 31st March 2019 will also go down. Now, this is your previous year, okay, 2019-20. This previous year begins from 1st April 2019. That's nothing but 31st March 2019. If the balance on 31st March 2019, closing balance of 31st March 2019 will reduce, accordingly the opening balance of 1st April 2019 will also reduce. You have to give the effect in the opening balances on 1st April 2019. If it is affecting any asset, give the effect in the asset. If it is affecting any liability, give the effect in the liability. Or if it is giving effect to any item of equity, then the item of equity will be getting adjusted. Very quickly, Once you detect a prior period error, ask yourself, is the prior period error for the previous year for which comparatives are given? Answer is yes. Give the effect in the comparatives. You realize that no, this mistake was not committed in the previous year. This mistake was committed in a year before the preceding year. Then whatever is the starting point of the preceding year, in the opening balances of that, you should give the effect. Remember again, as per Ind AS 1, this will become a situation where a third balance sheet will be required to be presented, right? A third balance sheet will be prepared. Presentation of the third balance sheet, we had discussed this earlier also when we were discussing the case of accounting policies. Understand, an entity shall present a third balance sheet as the beginning of the preceding period in addition to the minimum comparatives if it applies an accounting policy retrospectively. That was covered earlier, but see now, this is what will affect your prior period errors. Makes a retrospective restatement of items in its financial statements. That item of wages which was not recorded relating to 2 years back, 3 years back, I am giving a retrospective effect of the same. Or you are reclassifying the items in the financial statement. And the second condition, the retrospective application, retrospective restatement, or the reclassification as a material effect on the information in the balance sheet at the beginning of the preceding period. Not recording wages of 10,000 means you have overstated your profit. Right, you should simply ask yourself, is 10,000 rupees material for your company? Let's say the answer is yes. That means it's a material prior period error. We have to give effect for the same. Opening balances of the beginning of the preceding year, that should be adjusted. As I said in our example, remember, current year is 2020-21. Previous year is 2019-2020. That's what they say, beginning of the preceding period. Understand the words, beginning of the preceding period. This is your preceding period, and this period will begin on 1st April 2019. On 1st April 2019, I shall prepare and present the third balance sheet. Right, because the moment this mistake will be corrected in the year before 2019-20, it will affect the closing balances for the year before 2019-20. Effect of the closing balances for the year before 2019-20 will affect the opening balances for the immediately preceding year. And that is the reason a third balance sheet on that particular date needs to be presented. I'll give the effect retrospectively in the first set of financial statements approved for issue after the discovery by restating the comparative amounts for the prior period presented in which the error occurred. Or what if it has not occurred in the years for which comparative information is provided? Then what to do? If the error occurred before the earliest prior period presented, restate the opening balances of assets, liabilities, equity for the earliest prior period presented. By chance, let us say you are giving 2 years comparatives. You are giving current year information, previous year, and even before that also. And if the error was committed even before the second year for which comparative was given, then the beginning of that particular year. It's a very rare situation. Normally, we will be giving comparatives only for the immediately preceding year. And hence, at the beginning of the immediately preceding year, you need to restate the opening balances of the affected asset or the liability, or maybe simply the item of equity. For example, when wages will be debited to the P&L, it may simply affect your P&L. Then it is only the P&L. Hence, retained earnings balance will change. The opening balance of the retained earnings accordingly needs to be changed. But in case if you are giving any taxation effect for the same, let us say on those wages you are recognizing any deferred tax, then those deferred taxes may affect your deferred tax asset or deferred tax liability. Accordingly, the asset may also get affected. Then the opening balance of that asset, to what extent is getting affected, that should be disclosed. As we are saying, we should be providing the effect of the prior period item retrospectively, but by chance, let us say we are not in a position to bring about a retrospective calculation. Then just like as we had studied earlier for changes accounting policies, effect of the prior period error will be given prospectively from the earliest period possible. For example, you have committed some mistake, but you have been committing this mistake since last many years. Okay, now perhaps it's possible that I may not be able to give a full retrospective effect. Then to whatever extent it is possible, I shall give the effect. They say, when it is impracticable to give effect retrospectively, entity restates the comparative information prospectively from the earliest date practicable. You know, there are certain expenses which should be capitalized as per Ind AS 16, but you have not capitalized the same. In the current year, when you are carrying out the audit, you pinpoint that information to the accountant. You call in the accountant, you tell the accountant that, see, this expense should be capitalized. You are debiting it to the P&L, which is wrong. And you know what the accountant tells you? I have been purchasing PPE since last 10 years. Every time this expense has been debited by me to the P&L. I have never capitalized it. In other words, this mistake was committed since last many years. Now, since it was committed since last many years, when you say I will give retrospective effect, that means I should first find out in which year this mistake was committed first, and right from that particular date, I should carry out the rectification. But let us say doing these calculations for the last 10 years will be perhaps very cumbersome. It may even turn out to be very time consuming. Then instead of giving the effect retrospectively, I will bring the effect prospectively from the earliest date practicable. My accountant tells me that since last 10 years it will not be possible, but last 3 years records I can check, and whatever expense you are saying which I have debited to the P&L, now I will capitalize the same. Fair enough. Okay, it is fair enough. We can definitely give this effect. Final point that you have to understand, and this is absolutely against what we do in Accounting Standard 5. Actually, this last point is what you do in AS5. Correction of prior period error is excluded from profit and loss for the period in which the error is discovered. This is exactly what AS5 says. AS5 says, okay, the error was committed in the past, but give its effect in the period in which it is detected. Ind AS 8 says that the effect of prior period error can never be given in the period in which it is detected. Right? If you will give the effect in the current period itself, how can you say it is a prior period item? Prior period item means it should be something relating to the previous years. And if it is relating to the previous years, effect should be given in the previous years. Yes, there's one phrase that you should really concentrate on. They are saying an entity shall correct. Okay, I'm drawing your attention over here. It says an entity should correct material. You know, they use the word material prior period errors. I have made certain mistakes, and because of this, the expense will increase by 100 rupees. You can ignore it. You know, you can argue that simply 100 rupees which you have forgotten over here, it is fine. You know, it is not material. I will not give effect for the same. You must always identify that whether the mistake committed in the past is material. If you say it is material, only then its effect will be given. If it is immaterial, you can ignore the same. Definitely a question will arise that when can we say that the prior period error is material or immaterial? Of course, the decision of materiality or the judgment of materiality will be carried out on case-to-case basis. Sometimes the item is individually material, or sometimes the item is cumulatively material. You know, I may have committed 2-3 mistakes. Each mistake is a small one. But when I take a total of all the mistakes committed, it becomes pretty substantial. Then in that case also I can identify that although individually the items are immaterial, but still I will give the effect because cumulatively they are becoming material for me. Omissions or misstatements of items are material if they could individually or collectively influence the economic decisions that users make on the basis of the financial statements. The size or nature of the item or a combination of both could be the determining factor, isn't it? Either the size and the nature of the item, the single item itself is such that it is material, or as an individual item it is immaterial, but when I combine that with a lot many, then I realize that it is pretty material. Then I should give the effect for the same. I'll give the effect of the prior period errors retrospectively. If it is affecting only the previous year, then no need to prepare a third balance sheet. But if the prior period error is affecting period before the period for which comparatives are given, then you will have to adjust the assets and liabilities and the items of equity opening balance, and a third balance sheet also needs to be prepared. This third balance sheet is prepared not really as per Ind AS 8, it is prepared as per Ind AS 1. Suggest suitable treatment in the following cases. We are given an accounting issue and we are supposed to provide our response in terms of Ind AS 8. A carpet retail outlet sells and fits carpets to the general public. It recognizes revenue when the carpet is fitted, which on an average is 6 weeks after the purchase of the carpet. It then decides to subcontract the fitting of carpets to self-employed fitters. It now recognizes revenue at the point of sale of the carpet. Whether this change in recognizing the revenue is a change in accounting policy. We are supposed to decide whether they have given us a case of change in accounting policy. If you come to the conclusion that it is a change in accounting policy, then we'll have to give effect of the same retrospectively. Now they are saying that there is some retail outlet, it is selling carpets to the general public and it also fits those carpets, and it normally takes 6 weeks. Once the carpet has been purchased, it takes around on an average 6 weeks for the carpet to be fitted. And once the carpet is getting fitted, then they are recognizing the revenue. But now what they have done is they have started employing certain contractors, right? So we are having certain self-employed fitters. You have started employing them and you are giving the contract of fitting the carpets to them. Hence now the moment the carpet is sold, you start recognizing the revenue. You get my point? Earlier you were selling as well as fitting. Hence you were waiting till the carpet was fitted to recognize the revenue. Now you are selling and the fitting work has been outsourced to a third party, a self-employed fitter. Hence now you are of the view that the moment the carpet is sold, we should recognize the revenue. So that's the question. Is this a change in accounting policy? What do you say? You see our write-up for the change in accounting policy. Yes, I'll draw your attention to where they are saying that following are not changes in accounting policies. I'd given one example also earlier that you might be selling on cash basis, you might be selling on credit basis, but now you have decided to sell on approval basis. Now when you start selling on a new basis, obviously you will have to now design an accounting policy relating to it. And that is the reason we cannot say it is a change in accounting policy. You are changing the way you are doing your business. If you change the way you are doing your business, then obviously to reflect the new conditions of the business, you will require a new accounting policy. Here, when you are selling those carpets, now that the work of fitting the carpets has got outsourced, you are doing the business but in a different way. If you are doing the business in a different way, then you will require a new accounting policy which will reflect the new circumstances of the business. That's the reason we cannot really say that this is a change in accounting policy. If you read this, it will become very clear. Application of an accounting policy for transaction, other events or conditions that differ in substance from those previously occurring. What you were previously doing and what you are doing now, there is a difference between the two. And that is the reason we cannot say this is a change in accounting policy. This is actually adoption of a new accounting policy. If you check the response, this is not a change in accounting policy as the carpet retailer has changed the way the carpets are fitted. Therefore, there would be no need to retrospectively change prior period figures for revenue recognized. Retrospective effect is not required. This is simply selection or adoption of a new accounting policy. Case B. Entity ABC acquired a building for its administrative purposes and presented the same as property, plant and equipment in the financial year 2021-22. In 2021-22, you are acquiring a building. You are using it for administrative purpose, and hence you have classified that as PPE. Okay. Then they are saying during the financial year 2022-23, they are referring to the next year now. Okay, what are they saying now? They are saying that it relocated the office to a new building and leased the said building to a third party. This building is now leased to a third party. They say following the change in the usage of the building, entity ABC reclassified from PPE to investment property. Now you are saying that this building is an investment property. I believe till here there is nothing wrong. This is how it should be done. You are using an item of PP for your administrative purpose. I will consider that as a PP. If you say it is a PP, you should be applying Ind AS 16 over here. And once you start leasing it out to a third party, it will become an investment property. Here I'll have to apply Ind AS 40. They are saying, should entity ABC account for the change as a change in accounting policy? The building that was originally classified as PP is now reclassified as investment property. Can I say this is change in accounting policy? Be careful. If you say this is a change in accounting policy, you will have to give effect retrospectively. Retrospectively means as if right from the very beginning this building was an investment property. You know, before you judge whether it's an accounting policy or not, we have to understand it very clearly. By chance, if your answer is yes, if you say that yes, this is a change in accounting policy, you know what will happen? You'll have to reclassify the building as investment property right from the very beginning. But then the fact is that earlier I was using the building as a PPE. Right from the beginning, I was not using it as an investment property. Hence, the ultimate effect of treating this as a change in accounting policy will turn out to be incorrect. We have to understand over here that the classification of the building as an item of PP or as an item of investment property depends upon the objective behind acquiring that particular building. Okay, earlier the objective was to use it in our business, so we classified as PP. Nothing wrong in that. It's a right accounting policy, isn't it? Selected as per Ind AS 16. Similarly, now that you are no longer using it for your business, but you have leased out to a third party, your objective is to earn rental income. If your objective is to earn rental income, then this is no longer a PP. It has become an investment property. And hence I have reclassified it as an investment property and now applying Ind AS 40. Whether it is PP, whether it is investment property, that classification depends upon the definitions given in the respective Ind AS. Right? The classification depends upon the purpose, the usage, the objective behind this particular building. If they're asking us this is a change in accounting policy, what do you say? It is definitely not a change in accounting policy. We cannot say it's a change in accounting policy. You are only moving from one Ind AS to another Ind AS. Someone can always counter argue that, come on, change in accounting policy does not mean a change which is required by the Ind AS. You know, they say if required by Ind AS. Understand, you are already following a certain accounting policy as an item of PPE. Ind AS 16 gets revised and now a new accounting has been prescribed. This is what we refer as a change in accounting policy required by an Ind AS. Okay, moving from one Ind AS to another Ind AS cannot be said to be a change in accounting policy. Question is, should entity ABC account for the change as a change in accounting policy? My answer is no. Whether a building is an item of PP or an investment property for an entity depends on the purpose for which it is held by the entity. It is thus possible that due to a change in the purpose for which it is held, a building that was previously classified as PPE may warrant reclassification as an investment property or vice versa. Whether the building is in the nature of PP or investment property is determined by applying the definitions of these. Thus, the classification of a building as an item of PP or as an investment property is, here is the answer, is not a matter of an accounting policy choice. Accordingly, a change in classification of a building from PP to investment property due to change in the purpose held by the entity is not a change in an accounting policy. How should the reclassification be carried out? That's the subject matter of the independent Ind AS. Ind AS 40 has requirements of how you can move from PPE to investment property or how you can move from investment property to PPE. Ind AS 40 even considers inventory also. Inventory can also become investment property can also become inventory. There are different possibilities. All these possibilities will be taken care of by applying the respective Ind AS. We are not supposed to consider this as a change in accounting policy. Yeah, an interesting one. They are saying whether change in functional currency of an entity represents a change in accounting policy. Okay. Functional currency is a subject matter of Ind AS 21. Okay. Ind AS 21 describes certain conditions, transactions, events, and considering all that, you will decide what will be your functional currency. And once the functional currency has been selected, you will keep on using it as a functional currency till there is any change in those events, terms, and the conditions, right? Ind AS 21 itself suggests that if at all there is a change in a functional currency, its effect will be given prospectively. That itself makes it very clear that the functional currency is not exactly an accounting policy. Okay, because if it's an accounting policy, then its effect has to be given. Its effect has to be given retrospectively. This is actually all covered by Ind AS 21. It is not a subject matter of Ind AS 8. So do not apply Ind AS 8 over here. Functional currency is an integral concept of Ind AS 21. Apply the principles of Ind AS 21 and accordingly give the treatment for change in functional currency. Ind AS 21 specifically notes that an entity's functional currency reflects the underlying transactions, events, and conditions that are relevant to it. Accordingly, once determined, the functional currency is not changed unless there is a change in those underlying transactions, events, and conditions. Thus, functional currency of an entity is not a matter of an accounting policy choice, right? It is not a matter. In view of the above, a change in functional currency of an entity does not represent a change in accounting policy. Ind AS 8 does not apply. Actually, it's not given in the response that its effect should be given prospectively, but that is what Ind AS 21 says, that if at all there is a change in functional currency, you will change it prospectively. While preparing interim financial statements for the half year ended 30th September 2021, an entity notes that there has been an under accrual of certain expenses in the interim financial statements for the first quarter ended 30th June 2021. You are preparing interim financial statements. We know interim financial statements are financial statements prepared for a period shorter than a full accounting year. Here it seems that you are preparing the interim financial statements for a quarter. Your quarter has ended on 30th June 2021. there has been some under accrual of certain expenses. Certain expenses are under accrued. That means they are under reported. They say the amount of under accrual is assessed to be material in the context of interim financial statements. When you are preparing the interim financial statements, we are considering the under reported expenses to be material. Then they say, however, it is expected that the amount would be immaterial in the context of the annual financial statements. When you will prepare annual financial statements, that same item will become immaterial. For a period of 3 months, it is a material item, but for a period of 12 months, it is immaterial. Okay. Question, of course, is becoming very clear, although we have not read the question. There is a disagreement over here for certain items to be material or immaterial. Annually, they are immaterial. Quarterly, they are material. They say management is of the view that there is no need to correct the error in the interim financial statements, considering that the amount is expected to be immaterial from the point of view of the annual financial statements. Whether the management's view is acceptable. They are saying that whatever under accrual has happened, we can ignore that, because ultimately when we will prepare the full year accounting statements, that very item is going to become immaterial. Should we give a correction in our quarterly, the quarterly interim financial report, or we take a view that annually it is going to be immaterial? Hence, agreed that we have committed a mistake preparing the quarterly results, but we can ignore that. Because ultimately when the shareholder will read the full financial statements, by full I mean for the full year, then the mistake that we have committed in the interim financial report, annually it will become immaterial. What do you say? What do you say? See, you are preparing interim financial report, right? What you are going to submit to your shareholders right now is interim financial report. Whatever is material for interim financial report naturally has to be included. I cannot take decisions for interim financial report on the basis of what the annual figures are going to be, isn't it? For example, it's quite possible that during these 3 months my sales is very less, but annually it is going to be very high. That does not mean I make an annual projection and then find out what will be the quarterly sales. Similarly, it is quite possible that the expenses right now are very high, but in the subsequent quarters, I am of the view that the expenses will be less. Hence, whatever is the higher expenses of the first quarter, I want to allocate it to other quarters of the remaining year. I cannot do such kinds of things, right? Interim financial report is something that we are preparing as per Ind AS 34. Ind AS 34 is very clear. Allocation of income from one quarter to another, deferment of expenses from one quarter to another cannot be done unless and until it is permitted on annualized basis. When you prepare annual report, you should have annual considerations. When you prepare interim financial report, you must have interim considerations. That is in short what we can really say. Whatever is important in a quarter, it should get reflected in the interim financial report. Because right now the readers are reading interim financial report. They do not know that what is material right now annually will become immaterial, isn't it? That is the reason. If you are of the view that if you are of the view that there has been an underreporting of the expenses, then you should treat it as an error and rectify your interim financial report. Financial statements do not comply with Ind AS if they contain either material errors or immaterial errors made intentionally to achieve a particular presentation of an entity's financial position, financial performance, or cash flows. As regards the assessment of materiality of an item, judgment is always required, right? Whether it is material or not material, that will be always have certain level of subjectivity. So judgment is definitely involved. As per the above, while materiality judgments always involve a degree of subjectivity, the overriding goal is to ensure that an interim financial report includes all the information that is relevant to for an understanding of the financial position and performance of the entity during the interim period. It is therefore not appropriate to base quantitative assessments of materiality on projected annual figures. You can't take annual figures, project them, and then decide whether it is material or immaterial for your interim financial report, right? When evaluating errors in interim financial statements. Accordingly, the management is required to correct the error in the interim financial statement since it is assessed to be material in relation to the interim period data. Right? Your decision should be based on not what will happen in annual financial report, but what will happen or what is more relevant for an interim financial report. Is a third balance sheet to be prepared in the following cases? Of course, we are discussing these cases in context of Ind AS 8, but whether a third balance sheet should be prepared or not is a subject matter of Ind AS 1. Okay. As per Ind AS 1, when should an entity present a third balance sheet? They say an entity shall present a third balance sheet as at the beginning of the preceding period in addition to the minimum comparatives if, please understand, you are following some accounting policy and you are changing it, then its effect we know will be given retrospectively. Okay, there is some prior period error. There is some prior period error and its effect is also given retrospectively. Whenever an accounting policy is changed and the effect is given retrospectively, whenever you are discovering some error committed in the past and you are correcting that error and the correction of the error has been done retrospectively, that is the only time when a third balance sheet will be required to be prepared, provided the year before the year for which comparative information is given, that year is getting affected. You know, you should be first be very clear with that when a third balance sheet will be prepared. Please be clear with it. We know that whenever we are changing the accounting policy or the prior period error retrospectively, okay, whatever is the effect for the previous year, that will be captured in the comparatives. But if the year before the previous year is also getting affected, only then a third balance sheet will be prepared. Otherwise, there is no need to prepare a third balance sheet. For example, the error was committed in the previous year only, and in the current year I have discovered that error. Then I will give the effect of the same in the comparatives. Year before the previous year is not getting affected. No need to prepare the third balance sheet. I am changing an accounting policy. Effect will be given retrospectively, agreed. But the new accounting policy was selected in the previous year only. Okay, the new accounting policy was selected in the previous year. I will give the effect retrospectively, agreed, but only the previous year will be affected. Years before the previous year will not get affected. Then I do not have to prepare a third balance sheet. But that accounting policy which I am changing, I have been following that since last many years. The error which has been discovered was committed much earlier than the previous year. Then the year before the previous year is getting affected. That's the time when you present a third balance sheet. A third balance sheet is presented on the date of the beginning of the preceding year for which comparatives have been provided. Okay. It works something like this. Please understand, it works something like this. Your current year, let us say, is 2021-22. Okay. Hence, your previous year will be 2020-21. Right? We are saying beginning of preceding year, or we can say beginning of the previous year. Previous year, it will start on 1st April 2020. It is on this date that you have to present the third balance sheet. Okay. I'll just show you the literature and then it will become very clear. Just see what the Ind AS says here. Here it is. These are the words. you will prepare balance sheet at the beginning of the preceding period, right? Preceding period or previous year is 2020-21. Any change for 2020-21 will be captured in the comparatives, but the years before 2020-21 are getting affected, then you have to just present a third balance sheet, and the third balance sheet will be presented, as you can see, beginning of the preceding period. This is how it will be. Beginning of the preceding period. That's when I'll prepare the third balance sheet. If the years before the preceding year are not getting affected, no need to prepare the third balance sheet. I hope you are comfortable with when to prepare a third balance sheet and when not to. That will help us in these questions. Yes, what are they saying? They say an entity has presented certain material liabilities as non-current in its financial statements for the period up to 31st March 2021. While preparing annual financial statements for the year ended 31st March 2022, management discovers that these liabilities should have been classified as current. Okay, so it's a classification error. We can even consider this as misinterpretation of facts. You misinterpreted. Liabilities were current, but you have been disclosing them as non-current. This is definitely an error, and we need to rectify this error. And the effect of the error obviously will be given retrospectively. They say the management intends to restate the comparative amounts for the prior period presented, that is 31st March 2021. We absolutely agree with this. As you will do the reclassification in the current year, it will also have its bearing on the previous year. Previous year effect I'll give in the comparatives. Okay. Would this reclassification of liabilities from non-current to current in the comparative amounts be considered to be a correction of an error under Ind AS 8? Our answer to this question will be yes. It is indeed an error that was committed in the previous year and we are rectifying it. We will treat it as a prior period error. Question is, would the entity need to present a third balance sheet? Okay. The question to be asked over here is that because of this error where we have wrongly classified our liabilities, whether this mistake was committed only in the previous year or was it also committed in years before the previous year? If the mistake was committed only in the previous year, then you will give the rectification in the comparatives and the matter will end. But if the years before the preceding year are also affected, then a third balance sheet will be needed to be prepared. This is what we should check over here. Are the previous years, by previous years I mean the year before the previous year, is that year also containing this particular error? Okay. They say, look at the choice of the words now. I'm again reading the first para. Okay. An entity has presented certain material liabilities as non-current in its financial statements for periods. Look at the choice of the words. Periods up to 31st March 2021. Periods up to 31st March 2021. That makes it very clear that the mistake was also committed for the years before 31st March 2021. That means it is not just the previous year that is getting affected, even the years before the previous year are also getting affected. And when the years before the previous years are getting affected, third balance sheet should be prepared. If they are asking us, will a third balance sheet required to be prepared, presented? My answer will be yes. On what date should I prepare the third balance sheet? Okay. I'm writing in short. CY will stand for current year. You are finalizing for 31st March 2022. That means the current year is 2021-22. That means the previous year is 2020-21, right? 2020-21. The previous year begins on 1st April 2020. This is the date on which we should prepare our third balance sheet. Okay. Let's see the response. Financial statements do not comply with the Ind AS if they contain either material errors, immaterial errors made intentionally to achieve a particular presentation or cash flows, potential current period errors discovered in that period are corrected before the financial statements are approved for issue. Right now, I am finalizing my financial statements. In the current year itself, I am discovering certain errors. Then in current year itself, it should be rectified. But certain errors may still creep in, which I may not be able to discover in the current year. And I discover that in the next year or subsequent years. And that's when it becomes a prior period error. They say, however, material errors are sometimes not discovered until a subsequent period. And these prior period errors are corrected in the comparative information presented in the financial statements for that subsequent period. My first choice will be the comparative information. Okay. Then they are saying, in accordance with the above, the reclassification of liabilities from non-current to current will be considered as a correction of an error under Ind AS 8. Accordingly, the financial statements for the year ended 31st March 2022 and the comparative amounts on 31st March 2021 would be restated to reflect the current classification. Current year, I will do correct classification. Comparative information, also I will do the correct classification. Okay. Now they are saying, Ind AS 1 requires an entity to present a third balance sheet as at the beginning of the preceding period, in addition to the minimum comparative financial statements, if it makes a retrospective restatement of the items in its financial statements, and the restatement has a material effect on the information in the balance sheet as at the beginning of the preceding period. And finally, we come to the conclusion that yes, we ought to prepare a third balance sheet. They say, accordingly, the entity should present a third balance sheet as the beginning of the preceding period, that is 1st April 2020. We had already discussed this, right? This is the date on which you will have to prepare the third balance sheet, in addition to whatever corrections that you have already done in the comparative information. While preparing the annual financial statements for the year ended 31st March 2023, an entity discovers that a provision for constructive obligation for payment of bonus to selected employees in corporate office, which was required to be recognized in the annual financial statements for the year ended 31st March 2021, was not recognized due to oversight of facts. The bonus was paid during the financial year ended 31st March 2022 and was recognized as an expense in the annual financial statements for the said year. Would the situation require retrospective restatement of comparatives considering that the error was material? Okay. They are saying, while preparing the annual financial statements for the year ended 31st March 23, that means the current year is 2022-23. That means the previous year is 2021-22. Okay. They are saying that you have not recorded a provision for constructive obligation. Discovers that a provision constructive obligation which was required to be recognized was not recognized. A provision was to be recognized, but we did not recognize. But they are saying that this provision was to be recognized for the year ended 31st March 2021. Error has been committed. Error is committed, right? Error is committed in the year 2020-21. Then the bonus was paid and then we have recognized that as an expense. We have debited that in the previous year 2021-22. Question is, will you have to prepare a third balance sheet over here? They are saying, would this situation require retrospective restatement of comparatives considering that the error was material? What do you say? If the error was committed in the previous year, then simply changing the comparatives would have been sufficient. But the error was not committed in the previous year. The error was committed in the year before the previous year. In this situation, preparation of a third balance sheet will be necessary because you are giving the effect of the correction of the prior period error retrospectively. When should you prepare the third balance sheet? Third balance sheet should be prepared at the beginning of the preceding year. This is my preceding year. What will be the date of its beginning? It will be 1st April 2021. The third balance sheet should be prepared on 1st April 2021. Let's see the response. I am not reading this para. This is the same as part A earlier, right? This is also the same as part A earlier, that when should the third balance sheet be prepared, under what circumstances the third balance sheet should be prepared. That is what they are saying. Okay, the main answer starts here. In the given case, expenses for the year ended 31st March 2021 and liabilities as at 31st March 2021 were understated because of non-recognition of bonus expense and related provision. Expenses for the year 31st March 2022, on the other hand, were overstated to the same extent because of recognition of the aforesaid bonus as an expense. To correct the above errors in the financial statements for the year ended 31st March 2023, the entity should, obviously the first thing that you'll have to do is you'll have to restate the comparatives for the year ended 31st March 2022 and present a third balance sheet as the beginning of the preceding period. Just see, the date is 1st April 2021 as we had discussed earlier, wherein it should recognize the provision bonus and restate the retained earnings. Right? The expense was not of the previous year. The expense was for the year before the previous year. But because you did not recognize the provision in the year before the previous year, you debited the expense in the previous year. Hence, in the previous year, we will have to rectify the mistake. We will reverse it from the previous year expenses and we will debit it to the year to which it really belongs to. The moment you will recognize a provision, your retained earnings for that year will reduce. That's the reason they are saying that recognize a provision for bonus and restate the retained earnings. An entity charged off certain expenses as finance cost in its financial statements for the year ended 31st March 2021. While preparing annual financial statements for the year ended 31st March 2022, management discovered that these expenses should have been classified as other expenses instead of finance cost. The error occurred because the management inadvertently misinterpreted certain facts. The entity intends to restate the comparative amounts for the prior period presented in which the error occurred. Would this reclassification of expenses from finance cost to other expenses in the comparative amounts be considered to be correction of an error? Answer will be yes to that. Would the entity need to present a third balance sheet? Okay. As usual, first understand what's your current year. You are finalizing the statement for 31st March 2022. That means your current year is 2021-22. This will give me the previous year. My previous year is 2020-2021. Now, if I read the first para, they say that entity charged off certain expenses as finance cost in its financial statements for the year ended 31st March 2021. Okay. Error is committed by us. An error is committed by us in the year ended 31st March 2021. That means it is the year 2020-21. Error is committed in the previous year. For previous year, I will provide comparative information. I will restate the comparative information. The year before the preceding year is not getting affected, isn't it? See, the error was committed in the previous year only, not in the year before the previous year. Since the error was committed in the previous year, simply restating the comparative information of the previous year will rectify the error. The earlier years are not getting affected, and when earlier years do not get affected, there is no need for us to prepare a third balance sheet. Reclassification of expenses from finance cost to other expenses would be considered as correction of error under Ind AS 8. Okay. Accordingly, the financial statements for the year ended 31st March 2022, the comparative amounts for the year ended 31st March 2021 would be restated to reflect the correct classification. Okay. Then they have given us that when should a third balance sheet be prepared. We have discussed that many a times. I am just skipping that para. It is a repetition. We have already read it once or twice earlier. They say in the given case, the retrospective restatement of relevant items in items in statement of profit and loss has no effect on the information in the balance sheet at the beginning of the preceding period. Therefore, the entity is not required to present a third balance sheet, isn't it? The beginning of the preceding period, I mean the years before that, they are not getting affected. So no need to prepare the third balance sheet. ABC Limited has an investment property with an original cost of rupees 1 lakh, which it inadvertently omitted to depreciate in the previous financial statement. You are having an investment property and you have just not provided the depreciation. Ind AS 40 covers investment properties, and as per Ind AS 40, investment properties are also to be depreciated. You have not provided the depreciation. The property was acquired on 1st April 2021. The property has a useful life of 10 years and is depreciated using straight line method. Estimated residual value at the end of 10 years is nil. How should the error be corrected in the financial statements for the year ended 31st March 2024? Assuming the impact of the same is considered material. For simplicity, they are saying ignore the tax effects. Okay. As usual, understand your current year. You are finalizing for 31st March 2024. 2023-24 is your current year. What's your previous year? 2022-23. And I want to now know when was the error committed. Okay, when was the error committed? You acquired the property on 1st April 2021, and since inception you have not provided any depreciation. 1st April 2021. That means 2021, 22 is the year in which the error was committed. As you can observe, the error was committed in the year before the beginning of the preceding year, isn't it? And that is the reason. Not only the previous year will get affected, even the years before the previous year will also get affected. If the years before the previous year are getting affected, you need to prepare a third balance sheet. Okay. When will you prepare the third balance sheet? Not on the day you acquired the investment property, right? You have to prepare the third balance sheet at the beginning of the preceding year for which comparative information is provided. I will provide comparative information for the year 2022-23, and that year will start on 1st April 22. Third balance sheet will be prepared on 1st April 22. Okay. Non-provision for depreciation in previous year is a prior period error. To correct the above error in the annual financial statements for the year ended 31st March 2023, the entity should, okay, there is a slight mistake here. It should not be 2023, it should be 2024. To correct the above error in the financial statements for the year ended 31st March 2024, the entity should restate the comparative amounts, that is for the year ended 31st March 2023 in the statement of profit and loss, and present the third balance sheet as at the beginning of the preceding period, that is 1st April 2022. Right? That's exactly what we had discussed here, wherein it should recognize the provision for depreciation and restate the retained earnings. This can even give rise to certain deferred taxes because there can be temporary differences over here, and that's the reason they are saying that for simplicity ignore the tax effects. Otherwise, if tax rate is given, then you will also have to consider what will be the tax impact. Your current tax liabilities can change, your deferred taxes can change, and accordingly you may have to make revision even in your deferred taxes. But for simplicity, they are saying that you should ignore the tax effect. But yes, the end conclusion is that a third balance sheet is necessary. During 2022, Delta Limited changed its accounting policy for depreciating property, plant and equipment so as to apply much more fully a components approach, whilst at the same time adopting the revaluation model. We know in Ind AS 16, depreciation should be provided on component basis. Your items of PP should be broken down into its major components, and each of those components should be depreciated separately. That is what the company wants to do. And in addition to that, the company also wants to move to the revaluation model. Remember, moving from cost model to revaluation model will be considered to be a change in accounting policy. Okay. They say in years before 2022, Delta Limited's asset records were not sufficiently detailed to apply a components approach fully. At the end of 2021, management commissioned an engineering survey which provided information on the components held and their fair values, useful lives, estimated residual values and depreciable amounts at the beginning of 2022. They are saying that we want to follow the components approach for depreciation, but your records before the year 2022 are such that you do not have the necessary details. See, we have to break down the PP into its major components. Every component that has a significant cost has to be depreciated separately. I should separately find out what will be its useful life. I'll have to separately find out what is its cost. I'll have to separately find out what will be its residual value. And then each of those components will be depreciated separately. They are saying that all these details are now required. Without the availability of these details, you cannot move to the component approach. So that's the reason you have carried out an engineering survey. Now they say, however, the survey did not provide a sufficient basis for reliably estimating the cost of those components that had not previously been accounted for separately. And the existing records before the survey did not permit this information to be reconstructed. I want to apply the component approach. I want to do it from the very beginning, but I am not having the necessary information. We know that whenever you are changing an accounting policy, the effect should be given retrospectively, but at times, retrospective application of a change in accounting policy may become impracticable. If it becomes impracticable, then the change in the accounting policy should be introduced prospectively from the year from which it is practicable. That is what will happen in this particular. Just by reading this much, this is becoming clear. I want to change my accounting policy. I want to provide depreciation on component basis. But when can I do that? Only when all those details are available. I am not able to obtain those details. And if I am not able to obtain those details, even if I wish to give retrospective effect of the change in the accounting policy, how shall I be able to do it? Right? They say further in the second para, Delta Limited's management considered how to account for each of the two aspects of the accounting change. They determined that it was not practicable to account for a change to a fuller components approach retrospectively, or to account for that change prospectively from any earlier date than the start of 2022. I am doing this business since last 10 years. It means if I am changing the accounting policy, I have to do retrospective calculation for the last 10 years. But then I realize that this is not practicable. Then the next question will be that from what date will it be practicable? You may say that since last 2 years I can do it. Opening all the records for the past 10 years can be very tedious and time consuming. I don't want to do that. I feel it is an impracticable exercise. Then make it practicable. You cannot do retrospective calculation for the last 10 years, but can you do retrospective calculations for the last 2 years, for the last 3 years? Isn't it? Then you should give the effect from that particular period. They are even ruling that out over here. They are saying that we cannot do it retrospectively or to account for the change prospectively from any earlier date. They are saying that is also not possible. From current year only it will be possible. They say then the start of 2022. I'll have to give effect for the change in the accounting policy only from the current year and onwards. Also, the change of the cost model to revaluation model is required to be accounted for prospectively. Therefore, management concluded that it should apply Delta Limited's new policy prospectively from the start of 2022. Although you are changing an accounting policy, but then Ind AS 8 permits this. If the necessary information is not available for a retrospective calculation, then what can I really do? I will give its effect from the period it is practicable. They say additional information is given. Delta Limited's tax rate is 30%. Property, plant and equipment at the end of 2021 is given. Cost, depreciation and net book value. This is based on the previous year. That means this must be based on the cost model. Prospective depreciation expense for the year 2022, old basis. That means this is the depreciation on cost model. Some results of the engineering survey. Valuation is now 17,000. 17,000 is the value that we will have to consider as per the revaluation model. Estimated residual value, remaining average remaining asset life, and depreciation expense on existing PPE for 2022. This is the new basis. This is what will be done on the basis of the revalued model. You are required to prepare relevant note for disclosure. Okay. Only note is required to be prepared. I am changing the accounting policy. I cannot give its effect retrospectively because there is absence of data, right? All these things should be there in your note. I'm discussing in that way. You are changing an accounting policy. It should be done retrospectively. Information is not available, and hence we are doing it only from the beginning of the current year. You should also say that along with that, I'm also changing from cost model to revaluation model. You are changing an accounting policy. This change in accounting policy is not required by any Ind AS. You are voluntarily making this change. Understand? Ind AS 16 is not saying that you move from cost model to revaluation model. This is a voluntary choice that you have made. Whenever you are changing an accounting policy voluntarily, you can do it so, provided it will give the readers of the financial statements, the readers more reliable and relevant information. If you see our note on change in accounting policy, it is required by an Ind AS. This question does not fall over here. You are making a voluntary change. When can you voluntarily change it? If the change in the accounting policy results in the financial statements providing reliable and more relevant information about the effects of transaction, other events, conditions on the entity's financial position, financial performance, or cash flows. All these words should be there in your note. And after everything, after all the description that you have given, you will then have to give quantitative data that because of the change, what will be the effect on your financial statements? What do you say? What will be the effects on the financial statements? See, right now you are showing your PP at 11,000. Because of revaluation, you will have to show it at 17,000. Hence, carrying amount of PPE is going to increase by rupees 6,000, isn't it? 17 minus 11. That is what I am doing. 17 minus 11,000. That means the carrying amount of the PP. Okay, I'll write here 17,000 minus 11,000. The carrying amount of the PP will increase by 6,000. That should be described in your note. Okay, carrying amount of the asset is increasing by 6,000. If the carrying amount of the asset is increasing by 6,000, then this 6,000 is also a temporary difference. It will be a taxable temporary difference, and on that you will have to recognize deferred tax liability. Okay. Deferred tax liability will increase. Okay. 6,000 into 30%. The tax rate is 30%. Deferred tax liability will increase by rupees 1,800. Right. You are increasing the value of the asset. That means there will also be revaluation surplus. Okay, there will be revaluation surplus. This revaluation surplus will be recognized in other comprehensive income. How much will it be? It will be 6,000 minus this tax provision of 1,800. That is giving us 4,200. Okay, 4,200 will be required to be recognized as revaluation surplus, but of course this will not be recognized in the P&L. It will be recognized in OCI, in other comprehensive income. Okay. Depreciation. There will be a change in the depreciation also. Earlier your depreciation was 1,500. Now your depreciation will be 2000. Depreciation will be increasing by rupees 500. Okay. Depreciation will increase by rupees 500. How you are getting? By comparing the two amounts of the depreciation. I realize the depreciation will increase by 500. If depreciation is increasing, depreciation is an expense. Expense will be debited to the P&L. If expense will be debited to the P&L, it will reduce your current tax liability. Okay. Your current tax will reduce. How much will it reduce? Depreciation is increased by 500 and the tax rate is 30%. Okay. The amount is turning out to be rupees 150. Current tax liability requires to be reduced by 150. I hope you are comfortable with these figures. 17,000 compared with 11,000, your carrying amount will increase by 6,000. 6,000 into 30%, your deferred tax liability will increase by 1,800. Revaluation surplus 4,200. We have to take a net of the tax requirements. Basically, you will record both. You will first say 6,000 and then taxation 1,800, net 4,200. And depreciation is increasing by 500. And if depreciation increases, your tax expense for the year, that is the current tax liability for the year, should reduce. This is the note that we can prepare. From the start of 2022, Delta Limited changed its accounting policy for depreciating property, plant and equipment so as to apply much more fully a components approach, whilst at the same time adopting the revaluation model. Management takes the view, just see, this is a voluntary change in accounting policy and hence these words have to be there. See, management takes the view that this policy provides reliable and more relevant information because it deals more accurately with the components of property, plant and equipment and is based on up-to-date values, right? The policy has been applied prospectively. Actually, you should give retrospective effect, but I had to give it prospectively from the start of 2020 to explain the reason now. Because it was not practicable to estimate the effects of applying the policy either retrospectively or prospectively from any earlier date. Accordingly, the adoption of the new policy has no effect on the prior years. The effect, right? If there was an effect on prior years, then you would have also been required to prepare a third balance sheet, isn't it? They say the effect of the current year is to increase the carrying amount of property and equipment at the start of the year by 6,000. We've already seen this, how it is increasing by 6,000. Deferred tax will be increasing by 1,800. Revaluation surplus will be 4,200. Depreciation will increase by 500 and tax expense will reduce by 150. I believe I've already explained all the figures from where we are getting the 6,000. Here it is, the increase in the carrying amount of the PPE, isn't it? 6,000. Deferred tax liability, 6,000 into 30%. That's where you get 1,800. 6,000 minus 1,800, you get 4,200 revaluation surplus. Depreciation, 2,000 minus 1,500, 500, and 500 into 30%, 150. This is the note that we should be providing in our financial statements. ABC Limited changed its method adopted for inventory valuation in the year 2018-19. Prior to the change, inventory was valued using the first in, first out method. However, it was felt that in order to match the current practice and to make the financial statements more relevant and reliable, a weighted average valuation model would be more appropriate. You are changing the method of valuing your inventory. The method for valuation of inventory is understood as an accounting policy. All these years you have been following the FIFO, but it seems that your competitors, peers in the industry are following the weighted average. And hence I want to voluntarily change my accounting policy. We know that if the change in the accounting policy shall provide better information to the users, and hence the users can analyze the financial statements, the financial performance, the financial position, cash flows better, you are allowed to voluntarily change the accounting policy. That's what the entity is doing. The entity is going for a voluntary change in the accounting policy. The effect of the change in the method of valuation of inventory was as follows. We know if you are changing an accounting policy, its effect has to be given retrospectively. Hence, I will be following the new accounting policy as if it was been followed right from the very beginning. Hence, what will happen is certain change in the accounting policy will be for the current year that I have to capture in the current year figures. Some effect of the change in the accounting policy will be relating to the previous year, which should be captured in the comparative information, and the balance change will be for the years before the previous year. Now, when the year before the previous year is getting affected, it will basically affect the opening balances, especially the opening balance of the retained earnings. That effect you have to give in the retained earnings, and technically as per Ind AS 1, you will also have to present a third balance sheet. That's what they are doing now. They are saying that the effect of change in the method of valuation of inventory was as follows. Current year is 31st March 2019. Okay, this is considered to be the current year. This change will be given effect to in the current year. 31st March 2018. Now that's your previous year. This previous year information will be utilized to update, or I will say to restate your comparatives. And this is for 31st March 2017. This will affect the opening balance. Okay, this will affect the opening balance. Question is opening balances at what point of time? Okay, opening balances at the beginning of the preceding year. Okay, preceding year is 2017-18. Hence, you will have to give effect through 1st April 2017, or at times there are many companies who even write this as 31st March 2017. Whether you say closing balance on 31st March 2017 or opening balance on 1st April 2017, more or less that means one and the same. Okay. Now, 31st March 2017, your closing inventory will increase by 10 million. Will increase by 10 million. We just want to know what will be its impact on the profit or on the retained earnings. Okay. What will be the impact on the profit or on the retained earnings? I just want to know that. What will be its effect? Your retained earnings will increase by 10 million. The moment you will increase the closing inventory, naturally the retained earnings will increase. However, that will not be so when you do it for 31st March 2018. They are saying inventory will increase by 15 million, but your profit will not increase by 15 million. In the previous year, you are increasing the closing inventory by 10 million. That means the opening inventory for the next year will increase by 10 million. You get my point? Your opening inventory will increase by 10 million and closing inventory will increase by 15 million. That means there will be a positive impact of 5 million in your profits. The same thing will happen now again over here. Okay. Closing inventory of the previous year is increasing by 15 million. That means the opening inventory for the next year, or I would rather say current year, the opening inventory for current year will increase by 15 million and your closing inventory for current year is increasing by 20 million. Again, the profit will improve by 5 million. Then they say profit or loss under the FIFO valuation model are as follows. They have given us the average statement starting from revenue and reaching up to the profit. They say retained earnings on 31st March 2017. I told you, na? This is what will be affecting the beginning of the preceding year. The beginning of the preceding year is 1st April 2017. I can say 1st April 2017 or I can say 31st March 2017 were 423 million. Present the change in the accounting policy in the profit or loss and produce an extract of the statement of changes in accordance with Ind AS 8. We have to prepare an extract of P&L. We have to prepare an extract of the SOCE, the statement of changes in equity. 10 million is going to increase the opening retained earnings on 1st April 2017 or 31st March 2017, while the profits will be increasing by 5 million each for the current year as well as the previous year. What you should really do is, right, there's 173, right? Revenue will remain as it is. Revenue will not change, but the cost of goods sold will be decreasing. The moment the closing inventory will increase, the cost of goods sold will decrease. To 173 negative, I should add 5, and to this I should add 5. Add 5 in a sense, I have to reduce it. 173 and 5. Okay, we say 173 minus 5. That means for 2018-19, the figure will become 168. And here 164, and I reduce it by 5. Here the figure will become negative 159. And then whatever is the subsequent effect on the gross profit and the final net profit will be accordingly captured. If you see the answer, you will be getting these figures. Just see. 168 over here and 159 over here. That's what I was explaining you earlier. There's 173 which is there, it will reduce by 5, and this 164 is there, it will reduce by 5. I have written plus because they have written negative. They are saying minus 173. I am saying minus 173 plus 5. You get minus 168. Minus 164 plus 5, you get negative 159. Isn't it? So these are the two figures, and then you have consequent effect. This 156 and 137, 83 and 74 is remaining as it is in the question. 83 and 74 as it is. And the profits obviously will be increasing by 5 million each. Hence the profit is becoming 73 here and 63 here. Okay. If you see the profit, it was 68 and 58. 68 plus 5 and 58 plus 5. That's how I am getting these new figures. Hope you are comfortable with that. So this was the current year capture of the change in the accounting policy and the previous year comparatives. But by 10 million, my opening balance will increase. The year before the preceding year, there the profit is increasing by 10 million. Over there, only closing inventory will increase. Over there, opening inventory will not increase. And that is the reason, since only closing inventory is increasing, the overall profit will increase by 10 million. Hence, you should start with the balance on beginning of the preceding year. That's the reason I am considering over here 1st April 2017. They've already given 423, and to that I am adding the change in the inventory by 10. Okay, profit will increase by 10 over here, and hence the opening balances restated on 1st April 2017 will be 433. Then this 63 that I am getting, I am considering over here. Then I get 496, and then the 73 which I am getting, I am considering here, and I get the final balance of 569. Earlier the balance was 549. Now the revised balance will turn out to be 569. Just make few notes in your solution about the calculations that I have shown, right? This is what you can write in your solution. Show that how you are adding it by 5, adding by 5. The logic is very simple. Current year opening inventory, closing inventory both will increase. Previous year also opening inventory, closing inventory both will increase. But in the year before the previous year, only closing inventory will increase. Hence in that year, profit will increase by 10 million. Comparative profit will increase by 5 million, and current year profit will also increase by 5 million. 10 million, 5 million, 5 million. That means total the profit should increase by 20 million. Total profit should increase by 20 million. If you will compare these two figures now, the final one, 569 and the original figure of 549, you will realize that the profit is increasing by 20 million. If you are still writing, or if you are still making your notes based on what I have plotted in the solution, just pause the video here and complete it. It's the end of our answer. During 2016-17, Beta company discovered that some products that had been sold during 2015-16 were incorrectly included in inventory as at 31st March 2016. During 2016-17, you are discovering an error which was committed in the year ended 31st March 2016. Okay, In 31st March 2016, you have included certain products in the inventory which was already sold in that particular year itself. It means this item has been considered twice in the previous year. It got included in sales. It also got included in the closing inventory. Okay. Then they are saying accounting records for 2016-17 show sales of 1,04,000, cost of goods sold of 86,500, including 6,500 for the error in the opening inventory. In the first para, they are saying that certain items which were already sold in the previous year have got included in the inventory. The amount was not given. Now they are saying 6,500 error is there in the opening inventory. It will be opening inventory for current year, but for previous year, it was the closing inventory. It means the closing inventory of the previous year has been erroneously considered higher by or overstated by 6,500, and its eventual outcome is that in the current year, the opening inventory is also overstated by 6,500. And in the current year, there are income taxes of 5,250. Then they say accounting records for 2015-16 show. Okay, that means these figures are for 2015-16, while this paragraph is relating to 2016-17. Okay, in 2016-17, they are saying sales is 1,04,000. Now this table was not given, so I'm just preparing it. 1,04,000. Cost of goods sold right now is 86,500. I take 1,04,000 and from that I deduct 86,500. I'm getting this as 17,500. Tax they are saying is 5,250. From that I deduct 5,250. That means right now the profit is 12,250. Profit of 12,250 is considering the error which had been committed in the previous year. Now this question relatively is simpler in a sense that the error was committed in the previous year, and we know under Ind AS 8, if the error is relating to the previous year, you have to give effect in the comparatives. The error was not committed in the year before the preceding year. If it was committed before the preceding year, then its effect cannot be given in comparatives. Its information will be, its effect will be given in the opening balance of the retained earnings. And when I say opening balance, I mean the balance on the beginning of the preceding year. But that third balance sheet case will not happen in this particular case. Error was committed in the previous year. I have to simply give effect in the comparative information. Okay. They are saying that the error committed is that we have included 6,500 in the closing inventory for the year ended 31st March 2016. 31st March 2016 means this is the year 2015-16. In 2015-16, you have overstated your inventory by 6,500. By inventory, I mean the closing inventory. You have overstated by 6,500. Now, in the P&L, they have given us cost of goods sold, right? This cost of goods sold will be on a very rough basis, okay? In a very rough basis, it will be opening inventory plus purchases and all other expenses will also be there. After all, it is cost of goods sold. And from that, I will deduct the closing inventory. In general, we can say this is how you can calculate the cost of goods sold. You will be deducting the closing inventory. The mistake committed in the previous year is that closing inventory is overstated by 6,500. That means the closing inventory has to be reduced by 6,500. Please understand, closing inventory is to be deducted. The figure to be deducted will be reduced by 6,500. That means the total will increase. You get my point? What you will have to do is this 53,500 which they have given to us, I will have to increase this figure by 6,500. That means this figure will become 60,000. The correct cost of goods sold in the previous year, had the error not committed, would have been 60,000 rupees. I hope you are comfortable. Please understand, closing inventory is to be deducted. I will reduce the closing inventory by 6,500. A figure which is deducted is reduced. That means the aggregate will increase. And that's the reason 6,500 is added to 53,500 and I get 60,000. Okay. In the current year, previous year closing inventory will be reduced by 6500. Hence in current year opening inventory will reduce by 6500. Right, this is the formula that I have. Opening inventory plus purchases minus closing inventory. Opening inventory is added. The figure that is added will be decreased. The figure to be added will be reduced. That means cost of goods sold will be decreasing. Here the cost of goods sold is 86,500. This 86,500 will be reduced by 6,500 and hence the figure will become 80,000. Getting it? The figure for 2016-17 will be 80,000 while the restated figure for the previous year will be 60,000. Everything else will fall in place. Okay, everything else will fall in place because your cost of goods sold is the figure that needs to be changed. Okay, they have also calculated basic and diluted EPS, fine. And then they say in 2015-16 opening retained earnings was 20,000 and closing retained earnings was 34. Tax rate is 30% in both the years. Calculate the sales, deduct the revised cost of goods sold. Whatever answer you are getting, multiply that by 30%. That will be your tax expense. It has no other income or expense. Okay. Share capital of beta is rupees 5,000 and face value is rupee 1. Share capital is 5,000, face value is 1. That means there are 5,000 shares. In other words, whatever profit you are getting, you are dividing that by 5,000 and you are getting the basic and diluted EPS. Prepare an extract of the P&L and statement of changes in equity, providing the effect of the error as per Ind AS 8. Okay. Extract of P&L is to be prepared and SOC is required to be prepared. These are the figures that you will consider. In the current year, take the cost of goods sold not at 86,500 but at 80,000. Right? Current year, you will have to take it as 80,000. I have explained you how you got that. And then, just a second. Yes, and here 53,500 plus 6,500, you have to take 60,000. Here, 60,000. Right? Accordingly, you will get the profit before tax, then multiply by 30%. The rest of the figures don't have to be corrected. You will get it directly. You get 16,800 and 9,450. And then you have to divide that by 5,000 shares. That is what is giving you the basic and the diluted EPS. Right? 16,800, I'll just cross check, divided by 5,000. Yes, I am getting 3.36 and here you will get 1.89. So that's how the extract of the P&L will be prepared. And then of course you have to prepare a statement of changes in equity. These revised figures need to be considered. They have already given you the balance of 20,000. This is the 9,450 profit that you have calculated for the previous year. Consider that the corrected profit. And then you have 16,800, which is the profit for the current year. Consider that. You get the final balance 46,250. If you had not done any rectification of error, still the profit will remain 46,250 only. Okay, individual profits will turn out to be incorrect, but the overall profit will be the same because it is the same item which is increasing and decreasing by 6,500. You know, that is what is happening. In 1 year, I am reducing the opening inventory by 6,500 and in 1 year, I am reducing the closing inventory by 6,500. And that is the reason eventually there is no impact on the profit. The final P&L balance or the final retained earnings balance remains the same, but that does not mean I will not rectify the error. Error still has to be rectified because the individual figures of profit for the 2 years are incorrect. Ultimately, the final balance will turn out to be one and the same.